we'll see. There's going to be some overlap of some stuff I'm going to talk about vis-a-vis the two previous sessions towards the end of my talk. And one thing I should advertise at the outset is I'm going to do a really bad job of referencing the literature, but I'm going to be like consistent. I'm going to do a bad job of referencing my own papers too. So there won't be obvious biases here. But there's been a huge amount of literature that influenced what I'm going to be talking about. So I want to talk about these four subjects. I want to first kind of do a review and kind of a state-of-the-art discussion of asset pricing dynamics. I then want to talk about, I want to use that as kind of a motivation in part for a topic that I'm keenly interested in and been working on recently as well as a variety of other people. This is the scope for thinking about models in which there's some form of belief fragility. These are models which economic agents are struggling with what the heck is out there and what the consequences are for that, for asset values. Then what I want to do is look at briefly existing macroeconomic models, kind of what I view as the state of the art of those models, and these are quantitative models, and kind of what I think the important challenges are going forward in terms of linking them up to financial shocks and financial market transmission mechanisms. Then finally, I guess I want to revisit a topic that's already been covered from a somewhat different perspective. This is systemic risk, and the key thing in what I'm going to talk about is the measurement part, because the two previous talks kind of talked about systemic risk, but the measurement was kind of in the background a little bit. And I think there's huge challenges there, and I think we ought to, and so this is more like, these are kind of challenges for research going forward. So that's what I want. Okay, so let me just talk about, I'm going to do a job of kind of reviewing and put a little bit of a new twist on asset valuation and models in order to me to take inventory of where I think we stand. So models of asset valuation, I want to think roughly speaking as there being two channels, a stochastic growth channel, model that as a process G, some type of stochastic cash flow. It could be a macro cash flow, which is growing over time in some type of geometric way, growing arithmetically in logarithms. With that process, there's a bunch of risk exposures that are all encoded into it, and so those risk exposures which asset pricing models seek to price. So there's also going to be another process, stochastic discount process, which has been a very useful way to represent implications of models within the asset pricing literature. And so, but stochastic discount factor, it's stochastic because it actually adjusts for the riskiness of the cash flows. So it assigns risk-adjusted prices to cash flows. And kind of what asset pricing then is about is kind of how these two things interact. We can think about growth over some period 0 to t, discounting between 0 and t. These stochastic discount factors are defined in order that once we take these expectations conditioned on some initial state, say x naught, that assigns the value. Now, of course, S's and G's are all correlated. They're codependence is where all the action is, and kind of asset pricing models are in part about building models of this stochastic discount factor. And so we could just kind of stop here and say that all interesting stuff is encoded in formulas like this. I don't think it's the most fruitful place to stop, though. So we're going to keep going. So I'm going to write down an illustrative setup, and it's going to be a small shock setup, which is, you might say, why are we talking about small shocks? There's ways to extend this to large shocks and the like, but these are models over which there's some form of, there's going to be some form of state dependence in the mean. There's going to be some type of normal shock weighted by the alpha of xs here. And so it can be models that have so-called stochastic volatility. And so you can easily imagine accumulating a large number of normal shocks to induce approximations to fat-tailed distributions and the like. But what I'm going to talk about also does have extensions to other distributions, but I'm just going to do this for pedagogical simplicity. Okay. Now, if I'm a time series modeler, when I'm studying like output, investment, even financial cash flows, we often take logarithms because logarithms are the kind of are the nice things to build time series models about. They may grow arithmetically over time. And so we can think about this as like the logarithm of a stochastic growth process, say a macro growth process. You can also think about it as a logarithm of a stochastic discount factor process. And so typically, when we want to do asset values, it's this, in that formula, what we have to plug in is not yt, but the exponential of yt. So as y is growing linearly or decaying, if it's a case of discounting, decaying linearly, once I exponentiate, then I get this kind of geometric behavior. And if I've got some forms of nonlinearities inside x's, inside this beta and alpha, they start compounding over time. And if I'm looking at asset valuation over different investment horizons, then I have to figure out ways to characterize that compounding effect. So let me just do, as a warm-up to what I think, multi-period asset valuation, let's just review how one-period asset valuation works. I'm going to exploit the normality here. So imagine I've got this process G expressed in logarithms in this fashion. It's conditionally normal. I've got the process S expressed conditionally normal. I can form a one-period return. It's going to be take the payoff G, divide by its price. That's a formula for price. Then I can form the log of the expected return, just given by this formula. And I can just write it in terms of all these ingredients. And then this is the formula here. Now, the key thing about this formula is the following. The cash flow G is indexed by that alpha G, because that's how we're weighting the shock W1. Okay? The expected return, then, has an adjustment for risk exposure. Alpha G is giving me the exposure of the cash flow to risk. And this is giving me the adjustment here. And so this is not linear in alpha G, linear in this exposure. So I can think of minus alpha S as a price, as a risk price vector for this exposure to alpha G. So this is like standard linear pricing as we teach as we teach in microeconomics. And lots of implications about asset pricing models, even though they're dynamic models, end up looking at things like one-period risk-return trade-offs, and they end up telling us things about this vector, alpha S. So initial asset pricing puzzles that included things like the equity premium puzzle and various generalizations of it, looking across different classes of equity and the like. Macroeconomists think of the equity premium puzzle as having something to do with stocks and bonds, but there's characterizations far more robust than that. But it's all about the magnitude of alpha S coming out of the first generation dynamic stochastic models was small, unless we made risk aversion really enormous. If we made risk aversion really enormous, that had other problems. Okay? And then some repairs got invented to try to address this, to try to get interesting models, to try to get this, explain why that magnitude seemed, from empirical evidence, why that magnitude seemed large relative to models. And I should point out that a lot of the econometric challenges here were all about trying to devise methods that you didn't actually have to identify, you didn't have to even identify the shocks. One could use limited information approaches and still go through and try to figure out ways to put bounds on that object empirically, and those ended up being very potentially informative. Okay. But now there's some challenges to this, and the challenges came along along two avenues. One is recursive utility models that I'll talk a little bit more about subsequently, habit persistence models, extended to include social externalities, other models of investor preferences. So we go from the usual time-separable utility model to making preferences, in the words of, in the words of Zinn and co-authors, as exotic in some way or another. Okay. Now, these approaches, turns out that there's still a sense in which you have to appeal to large risk aversion. It's not quite as large. It may be large in some periods and not all the time, but there's still an aspect of large risk aversion to these explanations. There's an alternative literature that looks at implications for market imperfections. This goes all the way from solvency restrictions on solvency constraints on investors, Idiosyncratic shocks that can't be fully diversified, but which investors are exposed to, and also models of explicit private information. And this was another way to get a different model of stochastic discount factors. Empirically, this was a more challenging way to go because now one had to start looking more directly at microevidence, which kind of had its own set of empirical challenges with it, and was in some sense harder to even extract implications out of. But this was another channel which a fair amount of work was done. So either we change the market structure or we change the preferences. Both of those in special cases, this can give rise with tractable specifications of stochastic discount factors. Okay. Now, what I want to do is give a different derivation of that same pricing relationship, and I want to do this because I want to go beyond this notion of looking at one-period risk-return trade-offs. So even though a lot of the empirical literature, not all of it, Shiller's excess volatility of stock prices was certainly well beyond one-period risk-return trade-offs, but a lot of the empirical literature was about, even though the models were dynamic, looking at asset pricing implications from this more one-period pricing perspective. I want to go beyond that, but before doing that, I'm going to give a different derivation of the previous pricing result. And this one is nice because it extends to multiple investment horizons. And what I want to be thinking of here is analog to quantity and price elasticities coming out of microeconomics. So the notion of a quantity here is going to be exposure to risk, and then there's going to be the pricing that exposure. Okay, and I'm going to be working on computing so-called elasticities. And these elasticities are going to give me a way to think about counterparts to impulse response functions for nonlinear stochastic models. But I want to go beyond that. Standard macroeconomists, empirical macroeconomists, compute so-called impulse response functions. There's an impulse today. You want to see how different macro variables respond to it over a variety of different horizons. The asset pricing, if we're going to write down a fully specified asset pricing model, that you have a shock, say, tomorrow. That shock affects cash flows off of future time periods, and then you can look at the pricing consequences of that. So we can go beyond just asking quantitatively how important the shocks are and explain the time series. We can go back and use investor preferences to figure out which are the ones that command biggest prices in things like security markets as a way to think about implications. So that's where I want to head, is a way to try to characterize the dynamics of kind of risk pricing. But let me just first redo the derivation, and then we'll see that this has a direct extension. So what I'm going to do is I'm going to take some h here, and I'm going to take this h, and I'm going to imagine using this to form a perturbation. So I'm going to take the, I might take the original G or S process, and I want to perturb it a little bit, because what I want to do is I want to think, like in the case of G, I want to change the risk exposure a little bit, and that's just what this R is going to be doing for me. I've just adjusted it here, so the expectation. This should be log h, not h. The expectation of h would be 1, but I don't have to do that. That's just the usual log normal adjustment. Okay. And to make this aim towards an elasticity, I need to kind of normalize things to be 1. I'll just kind of normalize this entity here to be 1. Okay. Now I can price this object. Again, that should be logs. I can price G1 times H1. So now I'm going to price cash flows, but I'm going to change exposure a little bit, and I'm going to look at the pricing consequences of these. Okay, so I just formed this product, or kind of in logarithms here, and then I look at prices. Okay. So there's the expected return. I'm just going to now, quote, differentiate with respect to R. I'm just going to change the exposure a little bit. This is where I'm going to be computing essentially elasticities. I'm computing these logarithms. And I'm going to get a shock exposure elasticity. That's what this is. I've taken the cash flow. I've perturbed it a little bit. I'm going to get a shock value elasticity. I've taken the price. I've looked at the consequences for price. And then I back out the shock price elasticity as the difference between these two. One is this exposure elasticity. This is the overall value elasticity that has both a quantity and a price effect in it. And then out comes the price effect. And this matches, the good news is this matches the previous formulas, which were the basis of a lot of discussions of asset pricing. So now I've got this elasticity interpretation here, and this is going to extend to multiple investment horizons directly. And it's going to allow me to accommodate all sorts of nonlinearities. Okay, G, cash flow. Stochastically growing cash flow. S, stochastic discount factor. That's how I value the cash flow. What's H? H is going to be the way that I'm going to take that original cash flow and jiggle it a little bit. The way I'm going to jiggle it a little bit is I'm going to change how it's exposed to shocks. So I'm going to make it a little bit more exposed to some shock, okay? And then I want to look at the pricing consequences of that, okay? So that's what's going on. So yeah, G is stochastic growth, S is stochastic discounting. So now I can just, once I've got those calculations work for a bunch of horizons. Think of this as being some macro cash flow. Here I've jiggled around the exposure in the next period. The cash flow pays off at date t. This gives me a shock exposure elasticity. If I had a log normal model, this would be the same as a vector of impulse responses. If I have stochastic volatility, this accommodates it. I've got a shock value elasticity defined as before, and now I've got a shock price elasticity that just looks at the exposure elasticity minus the value elasticity. So this is the quantity, this is quantity and price, and that produces price. Okay, and this, so this kind of extends our notion of impulse responses from empirical macroeconomics. It allows us to think about pricing consequences over multiple investment horizons. Okay? And there's formulas for these elasticities, which you can work out in this normal case. As I say, one can work out in other cases as well that are potentially tractable and usable. Okay. When M is log linear, any of you that know about impulse response functions, these elasticities are just going to recover those. But now we can allow for nonlinearities, stochastic volatilities through means and the like. So these elasticities, I think, then are interesting inputs into so-called valuation accounting. How can I assess the different implications, pricing implications of alternative asset pricing models? Right? So, just as an illustration, I'm going to do the pricing calculation for a so-called recursive utility model and a power utility model and draw some comparisons. Okay. And this to kind of expose the differences in terms of dynamic pricing. Recursive utility is this model where we're reducing the, we're not going to reduce intertemporal compound lotteries. The intertemporal composition of risk matters. Krebs and Porteous motivated it from the standpoint of preferences for early versus late resolution of uncertainty, but in fact it has much more general implications about how you think about the intertemporal composition of risk. Okay. In pricing, it introduces this forward-looking channel that I'm going to have more to say about in just a couple minutes. It makes, from the pricing standpoint now, investors' beliefs about what's going to happen to the macroeconomy over potentially very long time horizons show up in pricing things even over one period. There's this big forward-looking channel, okay? And so I've taken some parameter values that come from some links to consumption, measured consumption dynamics, along with some preference parameters. And this is going to be a model that's going to have three boring shocks. So asset pricing just wanted to make sure that we could have some hope of linking the macroeconomy with asset pricing. It didn't think a lot of the work doesn't think hard about shocks, just because it wants some initial success before we start debating over what the shocks are. And so here I've got a so-called temporary shock, permanent shock to consumption, and then a volatility shock. Now, there's this forward-looking component to recursive utility. Okay? So what that's going to do is it's going to make the permanent shock be the shock which commands the biggest price. So the blue line here is the recursive utility model. The red line there is the power utility model. Now, for a power utility model, we're looking at models in which there's this component to macro risk that is arguably empirically small. In fact, it is, but the growth rates of consumption are predictable at low frequencies. The power utility model, it takes it a while for the pricing implications to kick in. The recursive utility model is forward-looking, and it just gets them immediately. The risk aversion parameters here are set to be the same, and the pricing implications over long investment horizons are essentially the same. Okay, but at shorter horizons, there's a big difference here. Which are the shocks that get the biggest kick? It's the permanent shocks, because it's a forward-looking component. If I look at the temporary shock, the power utility model actually does a little bit better, but the prices are trivial. These are in so-called units of Sharpe ratios, or familiar from people in finance. those are trivial numbers. So yes, the pattern may, the temporary shocks there are bigger, but it's a small number. And then there's also, this is a model with stochastic volatility. Okay, so there's the macroeconomy is going through phases of highly persistent stochastic volatility. This is again forward-looking, and so the recursive utility model gives you this flat trajectory. The power utility model, it takes a while as for this persistence to fully kick in. It takes many investment horizons before it kicks into similar magnitudes. So it just illustrates by looking at dynamics of pricing instead of one-period pricing how you can get some interesting comparisons across these models. There's a counterparts to this to habit persistence models with consumption externalities, a la Campbell, Cochran, Santos, Veronese, and others. The story is just completely different there. What happens is you get big temporary differences between the power utility model and the habit persistence model that eventually vanish over time. What happens there is you calibrate to low powers, and in the long run, the prices are all really small. So in the asset pricing literature, there's these two different types of models there. There's these external habit models. External means that they're backwards looking in the sense of you're comparing consumption to some weighted average of past consumptions coming from the kind of the overall macroeconomy in a fairly nonlinear way as well. But investors are not doing some forward-looking calculation. They're just doing a comparison of consumption to some reference point that's formed from past consumption. There are these recursive utility models with these kind of, which are the ones I've just advertised. This has the forward-looking channel with these very flat trajectories to things. The external habit models, then, the pricing dynamic shows up more prominently in those relative to recursive models. Okay. Both of these rely on large risk aversion sometime. The recursive utility model, the numbers I showed you were 10. The literature will go up to 20. The literature that links the macroeconomy and finance goes up to like 80, 100 without apology. So I'm not sure why there's no apology, but they go to huge, potentially huge numbers. So it's not that we get out of the bind of thinking about large risk aversion. Campbell-Cochran type models get big risk aversion in recessions, but not in good times. So you don't have big risk aversion all the time. But there's two questions that come out of this is, what macro shocks are priced? So I just made up some shocks. They weren't very exciting labels, like permanent, transitory, volatility. What's that? Are they structural models? Are these really models of investor preferences, which we want to be using for policy type analysis? And in the case of these consumption externalities, the asset pricing literature features them for recording empirical evidence, but there's not a lot of papers on the welfare implications of models with consumption externalities of this magnitude. This would affect counter-cyclical fiscal policy in a big way, and no one's writing those papers. So I really think this is more of a way to capture some facts, capture empirical evidence. So now I want to talk about fragility in beliefs, ambiguity and robustness. I don't know French, so I decided to produce the translation. Doubt is not a pleasant condition, but certainty is absurd. Now, what I want to say is it's not so much certainty it's absurd, which the certainty about probability models is a thing which I want to be challenging here. If we look at that model of recursive utility, there's a subtle component to consumption which investors just know. Econometricians have a heck of a hard time ever figuring them out. As a theorist, we can write down models as if we can fully specify all the probabilities over everything. But econometricians are all the time announcing their models are misspecified. I used to go to the money and banking macro workshop, and I'd say, well, here's this model, but it misses the time series here and there. Even though it's a rational expectations model, I was told that those were impolite questions because we know models are just crude approximations. So this notion that I think it's important to kind of try to come to grips here with this notion that we often use models as approximating things. And I think this gives different vantage points on stuff. It connects in part to this literature on ambiguity aversion, but I think it also has a little bit different, a different twist to it. Okay, so I want to talk about, so I want to take that recursive utility model, and I want to say it seems really silly to pretend that investors really know all the subtle components of, know parameters and all the subtle components of the macroeconomy, where econometricians can't possibly figure it out very easily. How do I get past those investor struggles onto those econometric struggles onto the investor? Okay, and so that's what's going to lead me to start thinking about models of so-called fragile beliefs. I'm going to endow investors with some skepticism about their models. And they're going to be making so-called robust adjustments. They're going to be engaged in some form of learning, but it's going to be really hard learning. They're going to be learning about stuff there's not much sample evidence about, and this is going to give rise to what I think of as a form of